Welcome back to Frank Abdo, where winning with your investments is what we're all about. Today, I would like to go to the charts and show you three charts. I want to show you the treasuries, the 10-year treasury, the oil index, and the Dow Industrials. I'm going to show you that in the chart formations that I follow and that are very informative if you give them a chance. I'd like to explain just a little bit before we get going on those charts. Number one, the treasuries. We're going to demonstrate to you why the treasuries are a bad investment, the 10-year treasury and the 30-year, but we're going to focus on the 10-year. The 10-year is paying the investor less than 3/4 of a point to invest his money for 10 years. So if you think about that, that's a horrendously low rate. And I'm going to show you why, if interest rates tick up to 1% or higher, or anything above 3/4 of a point, that bond is going to become worth less. Why? Because as the interest rates tick up and you have a lower yielding bond, then you're going to have to price your bond so it yields more money to the investor. For example, if you have a bond paying 0.75% and the interest rate moves to 1%, in the market, that's what the investor's expecting to get, 1%. But you've got a bond yielding 0.75%. You're going to have to discount that bond that you paid $1,000 for to equal 1%, which means it's going to be less than $1,000. Not going to do the calculation for you, but trust me, it's less. So as the bonds tick up in yield, the value of the current bond goes down in value. Second chart I'm going to show you is the oil market, the oil index, the CL index. That tracks the price of the light sweet crude. Light sweet crude is a very high grade oil. The oil companies will pay more for that oil because they can refine it less. Less expensive refining process gives them the ability to pay more for the oil. If you have a low-grade oil, like tar pits oil, something like that, which is very heavy, got a lot of junk in it, well, they've got to refine it a lot to get the oil to where it's usable. So they'll pay less for that oil. We're going to look at the current chart on oil. It went from $6.50 for the light sweet up to about $32 as it currently trades per barrel. That means at and there's 42 gallons in a barrel, that means at $6.50, that oil was trading for 14 cents a gallon. Now it's trading at $32, which is more. It's not quite $1. I don't know what the math is in my head, but it's more. And that's an indication that oil prices have stabilized or are moving higher. But right now, I believe there's some weakness that can show up in the market and drive the price back down to maybe $25. And I'll show you why. The last chart is going to be on the Dow itself, the Dow Industrials. Why I think the Dow still has room to run. I believe that the indexes are pretty clear on this. It was clear when the Dow was overpriced, and it's now clear that the Dow has further room to run up higher. I'm going to show you that in these graphs. Let's move over there now and get on with it. The charts, and I'd like to go over the three charts that I talked about in the opening video. I'm going to start with the 10-year Treasury Index. You can see it right here. This is the 10-year Treasury. And if we come over here and take a look at the three indicators that I find most valuable in determining the next direction, you'll see why I believe that interest rates are headed higher, and thus an investment in treasuries is not going to be profitable. The first indicator is the relative strength. Once the relative strength gets up here close to the 70 marker, that means that the treasuries are overbought and are due for a pullback. Now, it's got a ways to go before it gets there. As you can see, we're at 51 now. However, we're starting to see that in this area here, that the buyers are starting to dry up. We had a good burst when the buyers came in the market right after the sellers threw in the towel right here. And I'll show you on the next graph what actually happened, or the next chart rather. The treasuries hit a very low point right here. And you can see this, the sellers just threw in the towel and said, I've had enough, can't take it anymore. And then the buyers came in to buy them back up. And also this 2-line indicator is showing that the treasury, the 10-year, is getting near fully priced. The treasury, as we look at it right now, is right in this range here. It's leveled out. And here's what shows you that and what actually happened. As an interest rate moves up, the bond value moves down. That means if you have a bond like we have today trading at less than 3/4 of a point right here, trading for less than 3/4 of a point, if the yield by the treasuries moves up to 1%, this bond right here will become less valuable. The reason is that the bond holder is going to have to discount that bond in order to make it yield 1%. And that's going to cost them money. Now we saw that the line moved up. Just going to kind of push this aside for a minute and show you. You notice right here, we had a low on the bonds, and then the bonds spiked up. This is actually costing the bondholder more money. He's losing money as this line goes up. And here's what happened. You can see here on roughly the 24th, the 23rd, 24th, actually the 21st. We're looking at the 21st. That bond was yielding 0.58% for a yield, less than 1%. 0.58%. Now today that bond is priced at 0.73%. Like I said, that means that the bondholder lost money. It's an inverse relation, folks. So you can see right here, the bondholder lost money. That bond, this index was selling for $4, $3.98. It's now selling for $7.52. That means that the bond deteriorated in value. That's how you can tell what the situation is. I'll post that chart for you in the link below so that you can see it for yourself. The next chart I would like to talk to you about is the oil index. The oil index, which is the CL 1-year chart, this is the light sweet crude oil. Light sweet crude is the best oil there is. It's a high grade oil, meaning that the oil companies will pay more for that oil because it takes less refining, as I said earlier. You can see what a dramatic price, what a radical drop in price this was. From January 8th at $65 and change a barrel. A barrel is 42 gallons. So this traded at 65.65, or if you will, that was trading at, if I take 65, let me do it on a little calculator here. Come on, little calculator. $65.65 divided by 42 gave us a price per gallon of $1.56. It dropped to $6.50. So if I take $6.50 and divide that by 42, that gives us a price of 15 cents a gallon. It went from that price, look at that. And now today it's up at $31.66. So if I take the 31.66 and divide it by 42, that's 75 cents a gallon. That's still a massive drop from the 65.65 divided by 42, which is $1.56 or twice as much. But you can see that the recovery is coming in place. This was a dramatic drop in price, and you can see the frustration of the sellers right here. They were throwing this product away, throwing it away. And then finally, the buyer stepped back in, popped it up a little bit, and then the sellers came back in, drove it back down. It's clear right here. We can see it. And then finally, the sellers had had enough, and the buyers were willing to take back over. And we've got oil now moving up here. I will say this, and it's a very important point. Oil at $40 a barrel is break even for the American producer. He cannot produce oil for less than $1 a gallon and be profitable. If we lose the oil market in Texas and in Oklahoma and Nebraska and wherever else they're drilling for it, we're going to lose a lot of employment. We could lose millions of jobs. The United States is not going to let that happen, no matter who's at the command module, because we simply cannot stand that kind of unemployment. Eventually, this market is going to move right back up here into the $40 plus range. It's at $32, but it will move up. In the short run, though, I believe that the oil market will roll over and come back down, maybe into the, I would say 22, something like that, 23. But that's also driving the markets. As the oil market moves up, then Wall Street's more convinced that those jobs won't be lost. If those jobs aren't lost, then we'll have employment back where it should be, hopefully. Okay, the last indicator I'd like to talk to you about today is the Dow Industrials itself. We can see here the Dow hit 29,500. It's trading at 5,000 points, almost to the penny, lower today than then, but it is going back up. We can see that in this V-shaped recovery. Boom, and then back up. Why is that happening in such a dire condition with unemployment being what it is? Because Wall Street expects that to end. It was self-induced. People were forced out of work by the virus, and Wall Street gets that, and they know those people will be back to work. And as they talk about opening more and more stuff, Wall Street gets more and more comfortable with that. And those jobs that were temporarily lost were not lost voluntarily, either by the employee or the companies that let them go. The three indicators that indicate that we got a Dow that's going to continue to move higher is right here. The relative strength is just about halfway through. It's at 52. It could hit 70 or better. And then we can start to be concerned about an overpriced Dow, but we got a ways to go on that. You can see here the buyers came back in. Their buyers were swamping the sellers and driving the market back up from its low where the sellers threw in the towel. Sellers threw in the towel here, sort of, and we're just sort of tracking back up here. This indicator here, the Madcap 2 line, indicates that the Dow is most comfortable right in here, right above the line, right above the pink line. It gets uncomfortable either too high above it or too low below it. Right now it's reaching its comfort zone again. And that's why I believe the Dow's got more room to run. Well, that's it for now. Thanks for listening. Remember to comment and ask me any question you have. I can answer most of them. I'm fluent in the financial world. I can talk about Bitcoin, I can talk about currencies, commodities, you name it. But right now I'm trying to get people more comfortable with where the market is. Subscribe and click on the bell so you don't miss the next episode of Winning with Frank Abdo and Your Investments. Bye for now.